I am Gerardo Garcia. I'm the Director of Operations at Banco de Mexico, and I want to thank the organizers for inviting me to chair this session entitled Global Funding Spillovers. The session will cover two thought-provoking papers about two topics that are actually very close to my heart. I have been investing in the international reserve portfolio at Banco de Mexico for over 20 years, and I have had to deal very closely with the topics that will be presented today. One is the deviations from covered interest rate parity. That's the first topic. And the second one is about U.S. Treasury auctions, U.S. Treasury demand, and its impact on FX and bond markets. First, we will have Umang Khetan. Umang is a finance PhD candidate at the University of Iowa who will present synthetic dollar funding. The discussant will be Katarina Bergant, who is currently a researcher at the IMF. I must say that I really enjoyed reading the paper, as I think it contributes to current literature in at least three dimensions. First, it helps us understand why CIP deviations persist, but it does so from a very novel perspective in the sense that it does not focus on the traditional supply-side frictions in US dollar supply, but rather on the demand side that some banks, global banks, face in wholesale markets and some of the problems that they face in sourcing US dollar liquidity and then have to turn to the FX swap market to obtain a US dollar funding. So I think that's the very first important contribution. The second one is that it allows us to have a better understanding of how dollar funding stress is transmitted. And I think that is particularly important in the sense that you have today a lot of financial authorities, and this topic is very important for them in the sense that your paper, I think, also might give them some advice on how to enhance policy mechanisms. So if you want to give some recommendations, you have an audience that is financial authorities, and it's the right time to do it. And I think the third thing is that it stimulates further analysis of closely related issues. I think that your paper focuses on US money market funds, but certainly what comes to my mind is what happens also with other institutional investors that are important in sourcing US dollar liquidity. And I'm talking about pension funds that might be long-term investors, but also some sovereign wealth funds and even central banks who also participate in the sourcing of US dollars. So with that introduction being said, let me turn to you for your remarks. You have 25 minutes, please.
Thank you. Great. Thanks, everyone, for being here. My name is Umang. I'm a PhD student at the University of Iowa and really happy to present my paper, Synthetic Dollar Funding. Now, this paper is motivated by the vital role of US dollar liquidity in the international financial system. We know from existing research that a large number of firms around the world need dollar liquidity for trade credit, working capital loans, as well as long-term debt. And they mostly source these dollars from large global banks, which are the key intermediaries in these markets. But the interesting thing about dollar intermediation from international perspective is that a majority of dollars are actually lent by non-US banks. For example, Deutsche Bank or BNP Paribas here in the Euro area, or Barclays, Standard Chartered in the UK. And that's interesting because these banks traditionally don't have large dollar deposits in the US, and that raises a question of how do banks fund such large quantities of dollar assets. So when we look at the short-term dollar funding markets that these banks do rely on, we can categorize them into two broad types. The first is the traditional wholesale funding market, and we had a lot of discussion today about repos, for example, where banks issue repos, commercial paper, etc., mostly to money market institutions like Vanguard and BlackRock to raise dollar funding. But the second market that has become very important, particularly after the financial crisis, is the so-called synthetic funding market. The way this market works is that banks first raise a foreign currency, foreign from the perspective of US, of course, for example, the euro or the yen, and then enter into a foreign exchange swap to temporarily obtain dollars. Swaps are derivatives, which is why this form of borrowing is also known as off-balance sheet. And it's going to be the focus of this paper because the synthetic funding market is large and it has grown quite a lot. To get a sense of how big this market is, here is a chart from a recent report by the Bank for International Settlements, which kind of shows that a pretty large part of total dollar debt of non-US banks can be through synthetic sources like foreign exchange swaps. But beyond aggregate statistics, we don't really have a full understanding of what are the frictions that drive banks to use synthetic dollars and what are its broader implications both for asset markets as well as banks' dollar lending. And these questions are important because in the post-financial crisis world, we know that banks have faced increasing difficulty in raising dollar funding through traditional wholesale funding markets, partly because new regulations want to limit how exposed local investors are to these non-US banks. But this question has also taken on a renewed urgency in the last few months. There's a lot of concern expressed in the financial media that dollar funding markets themselves could be used as a negotiating tool in the evolving tariff policy, potentially restricting the flow of dollars to non-US banks. So the broader question we need to answer here is, what is the role of swaps in banks' dollar funding portfolio? Do they act as an independent source of funding, or do they interact with existing wholesale funding markets? And the second part of the story is about prices. We also know from a large literature which focuses on swap markets that the pricing in swap market is quite misaligned from fundamentals. Essentially what that means is that the cost of synthetic dollars tends to be higher than the cost of wholesale dollars. And that gap has real implications. There's work by some people in the audience here which shows that it in fact affects cross-border investment of firms. But what we don't have enough of is any kind of causal evidence on whether this particular demand from banks contributes to this pricing wedge. And these questions collectively are important because they help us better understand how wholesale funding frictions might affect bank lending in the presence of these synthetic markets. The key challenge in answering these questions is that swaps, because they're off balance sheet, we don't typically observe quantities data from these markets, definitely not in the standard quarterly call reports, for example. And that's exactly the challenge that my paper will try and overcome. I'm going to jointly analyze banks' use of wholesale and synthetic funding markets, and I'll show you three things over my remaining time today. First, I find that banks increase the use of synthetic dollars when they face constraints in the traditional wholesale funding markets. Why do they face constraints in funding markets? Because they run into these occasionally binding constraints on the amount of dollars that they need for fulfilling their dollar credit demand. And I'm going to show this with the help of a regulatory change that led to a very large decline in the availability of wholesale funding for banks, in response to which they significantly increased the use of swaps. This finding has two important implications. First, it tells us that there is a part of swap demand that's not driven by cost optimization between these markets. It is driven by quantitative limits in the wholesale funding market, which means that even though swaps are typically more expensive, banks sometimes have to use them to fill their dollar funding gaps. And the second implication, probably more from a policy perspective, is that to understand the full extent of dollar debt on the books of banks, we have to look beyond the on-balance sheet sources. We have to account for the use of swaps, which typically sit outside of balance sheet liabilities. Now, that takes me to the second finding, which I'll talk about today, which is that synthetic dollar demand from these banks contributes to covered interest parity deviations. Covered interest parity, or CIP, it's a fundamental asset pricing condition in international finance, which basically says that the cost of dollar funding in synthetic and wholesale markets should not be very different. And if it is, then it's basically an arbitrage opportunity. And that condition means that the cross-currency basis, which is the difference between synthetic and wholesale dollar funding cost, should be close to zero. In practice, since the financial crisis, the basis has been consistently negative, which means synthetic dollars are typically more expensive. And this has not gone unnoticed. There is a very large literature which documents this and tries to rationalize this phenomenon primarily by looking at the supply-side constraints within the swap market. By that, what I mean is that the swap arbitrageurs who supply dollars using swaps, they face increased balance sheet and regulatory costs. For example, leverage ratio that we heard about, which means that these swap arbitrageurs pass on these costs to the borrowers of dollars in the swap market. What I add to that is a demand-side counterpart. I find that when banks increase their demand for swaps, that turns the cross-currency basis more negative. And I make a causal claim here. I make use of frictions in the wholesale funding market to instrument for banks' swap demand, and I show that that indeed turns the basis more negative. And this finding has two important implications. First, it tells us that there is an important demand-side element to the kind of pricing phenomenon that we observe empirically. And importantly, from the perspective of these banks, it means that they're going to pay a premium to raise dollars in the synthetic market. And this cost scales up with their increasing borrowing. And when this cost scales up, it will naturally put a limit on how much banks can use these synthetic markets for raising US dollars. And that exactly takes me to my third finding. In the last part of the paper, I quantify the impact of funding market frictions on banks' ability to lend dollars in the presence of these synthetic markets. Now, this is going to be a very simple calibration exercise of the Ivashina-Sharfstein-Stein's model, where I'm able to trace what level of wholesale funding decline will actually affect bank lending, given that they can use swaps to offset some of that trade-off. And this is important because it helps us directly link to policy counterfactuals. For example, if US regulators were to further restrict non-US banks' ability to raise dollars in the wholesale funding market, when will that actually affect their lending behavior? So to visualize this model in a very simple schematic diagram, imagine that there is a representative bank which raises dollars from both wholesale and synthetic markets. When it faces a decline in wholesale funding, it switches to the synthetic market to make up for that shortfall. In the process of doing that, it ends up paying an extra price, which is the cross-currency basis. The extent to which it will pay that price depends upon the revenue it can make on those dollar assets. So in equilibrium, the cost and revenue curves intersect, beyond which the bank finds it more unprofitable to raise dollars in the swap market. As a result, they could either increase the cost of dollar credit to the end borrowers or cut down on lending altogether, both of which can be quite detrimental. So in my remaining time, I'll focus on the first two elements of this picture, which is that when there is a decline in wholesale funding, banks increase the use of swaps, and that has an asset pricing impact in the form of cross-currency basis. I'll leave the details of the model to the paper and just conclude with a brief takeaway from the calibration exercise. Okay, so I don't have time to go into the details of the literature, but I briefly want to mention what is my incremental contribution in light of all the work that has been done here. I'm going to talk about quantitative constraints in wholesale funding market that drive banks to use synthetic funding markets to make up for the shortfall, which has an asset pricing implication that goes beyond quarter ends, for example, which has been the key focus of the literature so far, and therefore my findings are generalizable beyond just quarter ends. All right, so we'll start off by talking about the demand for synthetic dollar funding. In terms of the data, I'm going to use money market funds as a laboratory within the wholesale funding market universe. Money market funds like Vanguard or BlackRock, they lend well over $1 trillion to non-US banks, and that makes them important players and suppliers of wholesale dollars. We also have very granular data available on money market funds. We can observe at a monthly frequency the dollars that they lend to all types of institutions at a non-anonymized basis, and that allows us to construct instruments using the granularity of that data. But we have to remember that these money market funds are quite constrained in the amount of dollars that they can lend to these banks. The key institutional feature of this market is that money market funds focus on capital preservation as their primary objective, not on very risky lending to generate very high returns. There's also other reasons why these funds can have quantitative constraints on how much they can lend to banks. For example, these funds are subject to investor outflows, especially after the 2016 reform, which I'll detail in a few minutes, and that directly impacts the banks that borrow from these funds. These funds also are subject to explicit regulatory limits. For example, they cannot lend more than 5% of their assets to any individual borrower on unsecured basis, which puts a cap on how much banks can borrow from these funds. They also have more internal limits, essentially to control credit risk that they can incur when lending to banks. The second market that we're going to focus on is the synthetic funding market, which is primarily executed using foreign exchange swaps. The swap itself is a very simple instrument. It's just like a collateralized term loan. And in the flow charts here, you can see that there's two main legs to this trade. At the inception of the swap, the borrower provides euro, let's say quantity Q, against which they borrow dollars, Q multiplied by the current spot rate. At the maturity, they will reverse the transaction. The borrower gets back the euro that they had lent, and this time repays dollars, but at the forward rate. Both the spot and forward rates are known at inception, so there is really no price risk in these instruments. And the difference between the forward and spot rate is essentially the swap premium, which should neutralize the interest rate differential between euro and USD in this context. In terms of balance sheet flows, if you imagine you are Deutsche Bank, you have very large dollar assets, which are the loans that you make in dollars. You typically don't have equivalent dollar liabilities. So you raise euro funding and then enter into an off-balance sheet swap to obtain the dollars to support your dollar lending. The challenge, of course, is because swaps are off-balance sheet, we don't observe quantities very easily. So to overcome the challenge, I make use of daily transactions data from CLS, or continuous linked settlement. This is one of the largest settlement agencies in the foreign exchange market and covers about a quarter to a third of the market in terms of transaction volumes. It allows me to quantify at a daily frequency dollars borrowed by different types of institutions in the swap market against a whole range of currencies and different tenors. There is a limitation of this data set that I would like to mention, which is that I observe these transactions, but I don't see the names of individual counterparties. I see their sectors to which they belong. And that's not going to be a challenge for identification because I use granularity of wholesale funding markets, but it is important to know in terms of what the data allows us to do and what we cannot do with it. All right, so here's just one slide on stylized facts from the swap market. This is a monthly time series of the total amount of dollars borrowed by global banks using swaps against all the currencies put together. And I'd like you to have 3 takeaways from this. First, it's a pretty big market. In my sample alone, there are months where banks borrow well over $1 trillion using swaps, which highlights that it's an important source of funding for large global banks. Second, it's a short-term market. Almost all of the borrowing is for up to 1 month in tenor, which is consistent with the fact that wholesale funding markets are also short-term. So when we think about substitution within these 2 segments, maturity imbalance is not going to be a major source of difference. And the third takeaway is that when interest rates go up, banks tend to reduce the use of swaps a little bit, like in the last 2 years of my sample period. And you might think that might be because at higher interest rates, maybe the demand for dollar goes down, but that's not what has happened. What's happened is that at higher interest rates, households move their savings from checking accounts to money market funds, which increases the availability of wholesale funding for banks, reducing their reliance on swaps. And we can see that directly in the raw data itself. All right, so that's going to be our first hypothesis, where we will test whether banks use swaps to offset wholesale funding decline. The regression we run here is very straightforward. It's changes in the synthetic dollar demand of banks against every currency C in month T on the availability of wholesale funding, which I proxy using money market fund holdings, controlling for prices, macroeconomic factors, and progressively adding fixed effects. And we can see that in this reduced form setting, there is a strong negative relationship between these 2 markets. As the availability of money market holdings declines, banks increase the use of swaps simultaneously. Economically, for a standard deviation decline in money market fund holdings, we're talking about a 23% increase in the use of swaps, which is meaningful. Now, this is, of course, a correlation, and one of the concerns you may have is that banks are probably just choosing the cheaper of the 2 funding sources. And so to the extent there is a change in the relative pricing between these 2 products, banks could switch from one to the other, so this shouldn't be a surprising result. I'm going to try and show you that this is largely driven by quantitative restrictions in the money market fund industry, not so much a cost phenomenon. And to do that, I'll make use of a regulatory reform, which greatly reduced the availability of wholesale funding for banks, in response to which they increased the use of swaps. In 2016, the SEC in the US implemented a series of reforms to the structure of money market funds, with the idea of improving their liquidity situation and preventing the kind of runs that we saw during the financial crisis. There were many provisions of this reform. For example, they had to introduce liquidity buffers, they had to introduce redemption gates, and change the way they report their net asset values. The immediate outcome of this reform was that once it was implemented, end investors withdrew a large amount of money from the money market funds, which directly impacted banks which were borrowing from these funds. The worst hit were the so-called prime funds, whose majority of asset allocation was in banks, and therefore banks across the rest of the world lost about $250 billion in a very short period of time in the form of wholesale funding. Now, I'm going to use this reform as an exogenous shock to the availability of wholesale funding for banks, and I'm going to make use of a difference in differences framework to estimate the impact of banks' use of swaps. Banks are going to be my treated units because they were directly hit by this reform. And other users of swaps, for example, funds or corporations, are going to be control units because they were not borrowing from these money market funds to begin with, which means the impact of this reform on their swap demand should be relatively limited. And that gives me a difference in differences setting where I can trace the impact of banks' use of swaps following the implementation of this reform. And I find that once this reform was implemented, banks significantly and persistently increased the use of swaps for raising US dollars, and this is not driven by pretrends, which lends a causal interpretation to this result. Great. One question on your mind might be that why can banks not simply pay more for wholesale funding? Why can't they offer much higher interest rates to money market funds? Because that might still be cheaper than raising dollars in the swap market. So why is that not scalable? And the reason for that is that money market funds focus a lot on capital preservation. Typically, they do not seek very high returns at the cost of bearing very large default or credit risk. And one way to show that in the data is to understand what's the relationship between the interest rates that money market funds charge and the amount of dollars that they lend to banks. And that's the plot on the left. Here, with issuer fixed effects and time fixed effects, I show that the relationship between the interest rates that banks pay and the amount of dollars they borrow from funds is not very strongly positive. In fact, it increases a little bit in the beginning, but then it just becomes a pretty much no correlation, which means that funds prioritize not lending more rather than lending at very high interest rates. In contrast, the plot on the right uses the maturity of these instruments instead of amount, and we can see that the relationship is much strongly positive, and therefore risk is a main factor that money market funds consider. Great, so we're going to move on to talk about the asset pricing implications here, asset price being deviations from covered interest parity, which is of independent interest as a major asset pricing phenomenon. But through the perspective of my story, what it means is that banks might be paying a premium to raise dollars in the swap market. And if they do, that would limit the usefulness of these markets in times of major funding stress. So what we really want to find out is the price impact of an increase in banks' demand for swaps. What we know from the literature is that swap arbitrageurs, they face balance sheet and regulatory costs of doing these trades. And therefore, the supply curve is essentially upward sloping. What we want to find out is how much will be the price impact for a given change in banks' demand for swaps. And we're going to run into a basic identification challenge, which is that quantities and prices are simultaneously determined. So we cannot just run a regression of changes in prices and changes in quantities. We essentially need an instrument that can shift the demand of banks independently of prices. And I'm going to construct that instrument using the granularity of wholesale funding data. The key idea is that banks are going to increase their demand for swaps when they face restrictions in wholesale funding market. And if we can capture these restrictions, and if they're independent of prices or any other swap market factor, we basically have an exogenous shock to their swap demand. And to do that, I'm going to specify the demand of banks in the swap market as a three-factor structure. There's going to be a price, which is what generates a simultaneity bias. There's going to be some kind of macro common factor to which all banks react. Omitting that generates omitted variable bias. It's the third component that we want to focus on. That's the idiosyncratic residual, or the quantity of swaps that only bank I will demand because it's not able to raise additional funding in the wholesale funding market. So what's the micro foundation? Why should we expect these idiosyncratic or bank level shocks to exist? There's a number of reasons. Let me just talk about the first one in the interest of time. There is a lot of cross-sectional variation in the availability of wholesale funding to different types of banks, even within the same country and same month. For example, banks have differential exposure to different money market funds. For example, if Vanguard lends to only 3 European banks out of 10, and if Vanguard suffers some kind of outflow because, let's say, they increase their fee structure, it only affects a subset of 3 banks and not everyone else, sort of like a shift share setting. These idiosyncratic shocks to the availability of wholesale funding, I extract them using the granular instrumental variables framework, and then I aggregate them to the banking sector level using the size of these banks. I call my instrument excess wholesale funding because what it essentially represents is the availability of wholesale funding to large banks in a particular country over and above the average or the mean trend in that country. Okay? In the first stage, I show that the instrument is relevant to explaining my endogenous variable, which is the swap demand. The regression here shows that an increase in excess wholesale funding strongly correlates with the changes in synthetic dollar demand of banks. Now, this is statistically significant, but importantly, the sign here is very sensible. It's a negative relationship, which is consistent with the story I've laid out so far, which is that when banks obtain large wholesale funding, they reduce the demand for swaps, and that's what the first stage here seems to confirm. I also verified that the instrument meets the exclusion restriction, especially that it does not capture wholesale funding constraints faced by, for example, US banks, which are likely swap arbitrageurs in this market. In the second stage, we then go ahead and look at the causal impact of banks' swap demand on prices being changes in covered interest parity deviations. In the first 3 columns, I'm using the first principal component of bases at 1 week, 1 month, and 3 months tenor. And then I have 1 week and 1 month separately in the last 2 columns. And across these 5 columns, we can see that there is a strong negative relationship. As the synthetic demand of banks goes up, the cross-currency basis turns more negative. Economically, for a 10% increase in demand, we're talking about more negative 7 basis points of the basis, which is pretty meaningful because the average basis is minus 26 basis points. What's also very important to note is that this result is neither driven by nor restricted to quarter ends. Quarter ends are special dates in these markets when banks tend to window dress their balance sheets. Even if we remove all of those months, we still find that this price impact goes through, which means that the economic force generating this result, which is wholesale funding frictions, is not restricted to just a few days of the year. Great, so with that, the last part of the paper, I have only 2 minutes left, so I'll go through this very quickly. We want to try and understand what all of this means for bank lending. Specifically, we want to quantitatively determine the extent to which synthetic funding markets can meet decline in wholesale funding that banks get. And to do that, I'm going to calibrate the Ivashina-Schaafstein model, where we have a bank which is able to raise dollars from both of these markets. But when it raises dollars in the swap market, it ends up paying an extra cost. The extent to which it will pay that extra cost crucially depends on the revenue it can make on dollar assets. So we're going to try and find out what is that threshold beyond which this cost-benefit trade-off becomes worse for banks, after which there can be a decline in wholesale in the dollar credit that is provided by these banks. Okay? So here's the key result from the model in just one picture. What I have on the x-axis is the availability of wholesale funding, going from 100% available on the left extreme to nothing available on the right-hand side. And on the y-axis, we're going to try and see what's the amount of dollars that banks can borrow from these two markets put together. Initially, as wholesale funding declines, banks are able to scale up the use of swaps to raise dollars synthetically. But the red dashed line is the threshold beyond which the additional cost of swaps becomes much more than the revenue that banks can make on dollar assets. At that point, they will either reduce lending of dollars if the end users are not willing to pay an extra price, or they'll pass this on to the end borrowers, both of which can be negative outcomes for these borrowers. Great, so I'm going to conclude here. This paper is motivated by the growth of synthetic funding markets, in particular after the financial crisis. And it is one of the first papers that jointly analyzes dynamics in both wholesale and synthetic funding markets to make 3 contributions. First, I show that banks increase the use of swaps when they face decline in wholesale funding, quantitative decline. Second, this particular demand is a contributor to more negative cross-currency bases. And third, this negative cross-currency basis ultimately places a lid on how much these markets are useful for banks to provide dollar credit. Thanks very much. I look forward to the discussion and your questions.
So we will now have Katarina discussing the paper. Katarina, you also have 15 minutes.
Perfect. Thank you so much. Thank you so much to the organizers for inviting me to discuss this paper. Obviously, everything I'm going to say, especially around swap lines, are my views and not the IMF's or its board or its management. It was a pleasure to read this paper. There is a lot, far too much to go through in 25 minutes, so you should all read it and check it out. This paper is very nicely done, very cleanly done. Also, I saw in the acknowledgements there were at least 10 discussants before me and another 20 people who commented. So he has taken on board many important comments, and this is already a very clean version. You should check it out. But because there is so much in this paper, I thought I should summarize very quickly the key takeaways, I think, at least for me. And then I'm going to offer 3 comments, 2 more for in the audience, policymakers and the markets, and 1 maybe how you can make it more appealing for an academic audience or a publication. But let me just summarize very quickly in a graph style what's happening here. So what's happening is that here we have a non-US bank, let's say German Deutsche Bank in Germany or even in the UK. It's a non-US bank. Where it is located is not important in this sense. But what is important is it's not a non-US bank. It doesn't have the deposit insurance on its US dollar liabilities, US dollar short-term funding. So what it does, it issues US dollar short-term funding, and a big holder of this US dollar short-term funding of non-US banks are US money market funds. On average, the paper says that 954 billion, that's not trivial. So basically, what this paper does, of course, it shows in a panel regression, but I much more like the exogenous shock of the money market fund reform, which decreases this lending by around 250 billion. So again, not trivial, more than a quarter. And then these non-US banks basically don't have enough US dollar short-term funding. So what they do, they go to synthetic US dollars, and the demand for that goes up, which means the price goes up, which means covered interest parity breaks. I mean, at some point, just because the price goes up, not mechanically, but at some point this affects covered interest rate parity. And then he does all of this with nice identification and instruments, and if this wasn't enough, there's also a model and a calibration, how this feeds to the real world. And the question is, does all of this now affect the US dollar lending by these non-US banks, which is why they borrow the US dollars in the first place? And the answer is yes and no. No, because small fluctuations in their funding shortages can be made up by the synthetic market. But if the curtailing in this lending is very large, and here this calibration is 20%, you have to take this with a grain of salt, but then the banks will actually cut their dollar lending, because as every regulator in this room knows, they're no welfare organization. Their primary goal is to make a profit, but then the marginal base exceeds the marginal returns, and they will either scale back the lending or increase the price, which both ends up in a decrease in the volume. So here you have the last stage. From this, you then go back to the non-US dollar, non-US bank that then cuts lending. So this is this paper in a nutshell, and a very complete exercise. I'm gonna make 3 comments, as I said, because what we haven't heard from Umang today is, where does this leave us? So what should we take away from this story, from this very clean and nicely done exercise? I'm gonna offer some implications for economics and for economic policy. Maybe this is more, as Isabel said, this room kind of brings together policymakers and academia. Maybe for policymakers this is more interesting. And then I'm also gonna say something on the academic contribution of the paper. So this is a paper about the determinants of covered interest rate parity. So just to make very clear how the covered interest rate parity comes here, is that covered interest rate parity is defined by the fact that on the left-hand side, the dollar interest rate should be equal to, let's say, I'm taking the euro dollar here because we're here at the ECB, it should be equal to the euro interest rate, and then the ratio of the spot and the forward exchange rates. So basically, you can't make, there's no free lunch, and you can't make profit by just trading this. And you can rearrange this by saying the CIP deviation is 0 when the difference between the two is 0. And in this paper, in Umang's paper, and in general in this literature, I think Do et al., if the JF paper, if I'm not mistaken, comes up with this cross basis, and you end up with this. Equation that the cross basis, which you can interpret as the covered interest rate parity, is equal to this dollar interest rate minus the euro interest rate minus, and this is now the swap price. So if you go back to the whole model as we had it, the price here comes into the CIP here. But how big now is this? How big does this have to be? And what the paper doesn't tell us is how big this really is in explaining covered interest rate parity. Let us take another step back and say, are CIP deviations actually rare? Because this is how you also motivate part of the study. And if you take this paper by Do et al. In the Journal of Finance, you see that actually before the GFC, there were very little CIP, but after the GFC, this is a pretty big phenomenon, and you take this as a motivation. Well, actually, now we have more data, and there's a new paper by de Gorse et al., who dug out this CIP data since 1920, and he shows that actually this little phase here before the GFC was actually more an exception, that it was really small. Large CIP deviations are more the norm. And it is a question in terms of your story, how much you contribute to this. So taking your micro findings back to the aggregate would help us to understand how much of these large deviations we're explaining. Because do you explain everything with this? If you look at large patterns for CIP deviations, here the US dollar, this is work done by my colleagues in money capital markets. If you look at CIP deviations relative US dollars, you see that largely they correlate with crises and macroeconomic uncertainty. They're not so highly driven by the demand for swaps, but demand for swaps can certainly be an amplifier. And I think this is how the paper should be pitched. It's basically how it works is that we have an adverse macro financial operational shock, which changes the FX flows, financial flows, trade flows, remittance flows, and then it's amplified by some factors, for example, currency mismatch, dealer concentration, NBFI, and also these dealer balance sheet constraints. And it would just be interesting to see how much this contributes to the aggregate. So where does this leave us? What are the risks now for going ahead for policymakers? What should we think about? I think what the risks are is that these FX markets, which are growing, by the way, in size a lot, create overall tighter financial conditions, and what you're showing is this can spill over to other assets. What the paper is very silent on is what we could do about it. So we just heard that this would have been your chance to make policy conclusions to a large audience. So I'm going to do it for you. I think the most important to take away is that swap lines are very important. Okay, they're unilaterally supplied, mainly supplied by one entity, which I would say at the least I can say that the predictability is becoming less accurate. And the ECB has a standing swap line with the Fed, but many rely on these crisis-induced swap lines that they use. I mean, just in COVID, several countries like Korea, Australia, all of these had at least 60 billion of swap lines. I think the ECB had something like 140 on its standing swap line. So this is very important to secure this, because stress in these markets is getting more and more important for macroeconomic. Another thing is reduce FX mismatches in the first place. If you hold the same duration on your asset and liability side in US dollar, that's another one. Ensure adequate capital, but also reduce dealer concentration. Because if you're reliant on a specific set of suppliers of your short-term funding, of course you're more exposed. So I'm gonna close with my last comment, so what I said until now, I think that's how you can make your work more appealing to the policy and the markets audience, but you probably want to sell this to a journal because it's very nicely done. And for this, I think you need to really flesh out the contribution. I do agree with you. It's the first paper that together studies this wholesale and demand channel. However, it's important to clarify what the answer to which questions have we really learned is new. Because we start with Borio et al. That already says that the sign for CIP deviations reflects the demand in swaps. Then we have Wenchins and al. JF paper that says that demand for hedging determines CIP deviations. Leo et al. Focus on EMs. They also look for the demand for swaps by foreign investors that then drive CIP in emerging markets. Then this panel's Tony paper also looks at hedging channel for exchange rate determination. And you just need to be really clear in what additional question you answer in respect to their work. And most importantly, probably there's Anderson et al. That uses the exact same instrument that you use on the money market reform. And what's particularly interesting of your paper in relation to theirs is also that they show a bit of a different channel, right? They say that the money market reform hits and that kind of reduces the arbitrage capital. And then also subsequently the supply should go down, where in your story, actually the demand from the bank side goes up. So it would be very important to show how you reconcile this supply and demand story with their work. But to conclude, this is a great paper, well written, well identified arguments that will certainly enhance our profession's understanding of covered interest rate parity. I know Umang, I think, is also going on the job market, and if you won't hire him, we certainly will. So maybe I shouldn't have advertised this.
So now let me open the floor for questions. Let me see if there's any. Yes, please.
Thank you very much. So I'm Ileana Pietraru, and I work for a non-US bank in Europe. It's not Deutsche Bank, it's a French bank. Thank you very much for your presentation. I have to say, I don't recognize always some patterns that I see in our bank or in, among my peers, meaning that since the great crisis in 2008, we learned many things. First of all, was not to rely on FX swaps and or cross-currency swaps to be funding assets that are, in different currencies. And I'm pretty sure that supervisory teams are also very keen to look at that in a bank's balance sheet. So I would say that banks don't really use them for funding reasons. We have to keep in mind that the funding in a bank and market making are quite separate. So maybe there are also some clients that are on the other side and who actually can be taken for bank demand. Also, I would think that when you look at the page 5, you had this chart on the basis since 2008, and you see that in that time it was really a huge shock. And my question is, do you think that this, and since then, the shocks were smaller? Do you think it has to do with the positioning of the transformation of the liquidity? Do you think that banks now are less short than before, and this is why the basis, when it widens less than in 2008? Because the difference between 2008 and now is that banks are far more liquid. So my question is, did you look at the maturity transformation in your data and your paper?
Yeah, absolutely. So thanks for the questions and thanks for the great discussion, Katrina. So for sure, you're right that these same banks could be doing market making as well, and they could be supplying some of those dollars to their end clients. And that is actually true. And we do see that a little bit in the data. So here, for example, is the both borrowing and lending side of the swap market from the perspective of banks. And if you see on the lower part that's below zero, they're actually lending dollars in the longer tenor of the swap curve. And that's the maturity transformation as well. So you're completely right that banks use these swaps maybe not only for internal funding, they could also be supplying it down the line to their end clients. And we see that in the data. But even if you take that, if you take account of that, it still seems like there's a large amount of dollars that banks still keep. Now, whether they use it for making, let's say, trade credit or they use it for other purposes is a bit hard to see in the data since we don't observe the full balance sheet of banks. But I think your point is quite right. And if I understood your second question correctly, also on the basis widening more after the financial crisis, it's not just that the demand has gone up. We know that the supply side constraints have also picked up, especially from the perspective of swap arbitrageurs. And you need an interaction of both for the price effect to actually hold. So I think both of these factors are relevant. But my story is more on the demand side from the perspective of global banks, which I think is less well understood. Thank you.
Yes, we have one here and then one there, please. Okay.
Thank you for the presentation. I'm the group treasurer for BNP Paribas, so another French bank. And so before you go sell your paper, I would strongly advise that you come for a discussion at one of the breaks. Because indeed, we do not finance dollar assets, neither with FX swap nor with repo. And you have to make a clear distinction between unsecured world, which is essentially the banking book, and the secured activity where you have the dealing activity and the market making. And when we talk about repo, it's true that in the match book you have maturity transformation. When we talk about FX swap, it is not. And most of the time, it is even the other way around. We can lend shorter than we actually borrow. And when I say we, it's because within the banking group, the dealer is part of the bank. So regarding the causality which you mentioned, my answer, and I have the visibility on absolutely every corner of the balance sheet of the full group, I can tell you the answer is a strong no, absolutely not. Yeah, so happy to discuss further after.
For sure, let's talk more.
Over there, please.
Hi, I'm Jean Frieda from the London School of Economics in Blue Crest, and I'm not French. Not yet. Firstly, thank you for the paper. It was, in financial markets, we talk a lot about the left tail of the dollar smile. And we have this kind of, conceptual framework of dollar demand in periods when there is financial stress and dollar demand in periods of exceptional US growth. And I feel like it was the best exposition and quantification of that left tail that I've seen. So congratulations. The question I kind of had was, you link the provision of synthetic dollars to wholesale funding of the banks, but it kind of hits a point where the curve, the supply curve flattens as a function of the marginal cost being equal to the marginal return. And I guess I think about it a little bit differently. That left tail concept is basically telling you there comes a point where the provision of synthetic dollars becomes part of the propagation mechanism itself. You actually the supply starts going down as a function of uncertainty over the value of that marginal return. And it sort of made me wonder, and this gets at some level to the questions that the discussant raised, as to how one would distinguish between that cutoff point where the Fed comes in to provide dollar liquidity, and whether you could actually distinguish between, because I don't think empirically you can thus far, distinguish between episodes where the Fed is providing liquidity liberally and the Fed is providing dollar liquidity to foreign counterparties, and particularly other countries, liberally.
You're right. So in the data, we don't have that much granularity. We do see the swap lines data that does come from the New York Fed. And they've become kind of standing facilities after the COVID crisis. So there is still drawdown that happens, but of course of much smaller magnitude. And in terms of Fed liquidity to foreign banks, I'm not aware of any granular data that would allow me to do that kind of exercise, but I can look a little bit more. What I do see is the foreign banking organizations in the US, so basically branches of foreign banks, they do report some of this at a quarterly frequency, the amount of dollars they draw down, for example, from the Fed reserves. And that tends to be a relatively small number relative to kind of markets that we're looking at here. But I can look a little bit more into what kind of granular data might be available for looking at the link between Fed supplying dollars to these non-US banks. Thank you.
We have time for a final question. Pat Maguire over there, and then if we have time, we can, yeah.
Thank you. Pat McGuire from the BIS, and I'm sort of reacting to the paper as well as I think the comments from our French bank colleagues on the other side of the room. So I think this CLS data set has become quite popular. BIS has just bought this. But I think there's something really important to keep in mind with this data set, and that is you're capturing basically the interdealer market. Our other BIS statistics are putting outstanding FX swaps at about 120 trillion. The dollars on one side of virtually all of those. CLS has like 23 trillion, 2 trillion of which is with non-banks. So some of the work we've done with the data set shows that, the same top 30 banks in the world are market makers in these markets, and they're offsetting clients who are borrowing and lending dollars. They have to match. So small changes in the hedging ratios of a pension fund in Asia generates, trillions of dollars of flows in swaps that the dealer banks then offset in the intra-dealer market to balance their off-balance sheet books. Since the story we told during the crisis was that there were big on-balance sheet mismatches on the commercial banks. Too few dollar liabilities, too many dollar assets, and they funded those and hedged those with swaps. That is almost no longer the case for many banking systems. French banks are dollar providers. UK banks are dollar providers because of their on-balance sheet assets. So some of the graphs you showed in there of short-term dollar borrowing in the CLS data is, in my view, would be reflecting more client flows coming in from the 80 trillion in non-bank swap activity that you can't see that gets offset in the dealer market. So just a comment.
Thank you. So there is 2 cuts of the data that CLS provides. There is one cut, which is the interdealer segment, like you rightly said, and some of that is sort of a derivative flow coming from the client's end. And there is a cut, which is between the select set of banks and other smaller banks, so non-dealer banks. And the graphs that I'm showing you is from this large global banks facing these non-dealer banks. I'm also accounting for the client flows to the extent we see it, but you're right that CLS data doesn't capture a large share of it. So that's definitely a source of bias in the data for sure.
Fortunately, we have, but very quick comment or question, please.
So when we created the swaps with the Fed, we never thought that they would become a highly political issue. Now they have become a very highly political issue because of the attitude of the Trump administration. And the attitude of the Trump administration is creating uncertainty about the availability of these swap lines. My question is whether you see any evidence of this uncertainty in the market for swap on the dollars. I mean, the difficulty in foreseeing whether this would be available or not, is it already having an influence on prices?
So unfortunately, my data sample ends in 2023. If I get a more updated data, maybe I can answer that question better. But CIP deviations, they seem to still be there. And I think we can take a look at whether these recent price moves may have something to do with that uncertainty. I haven't done it, but that's definitely an interesting thing to look at further.
On my side, CIP deviations haven't moved as much given this uncertainty that you mentioned. So I would say that at this point, not, at least from my perspective and coming from Mexico, I haven't seen that widening of CIP, and I think it's the case mostly all over the world, but it's certainly something to take consideration and to look at. Thank you.